Okay, so here we go. My fan base is shrinking. Am I doing something wrong? Yeah, delivering long and boring lectures to an audience that wants to be entertained with short, charming lectures. But that is not the path to wisdom, young grasshoppers. Long, boring lectures is the path to wisdom. We have adequate time for me to actually give the interest rate lecture in classroom. I was planning originally, thought I might have to do it by video, but I've completed the put and call lecture, and those require only 2 lecture presentations. They aren't very long, and we have 3 remaining available, so I'll just keep with the more or less the course outline and deliver this in the classroom. We were supposed to have started the put call stuff today, but I always give 6 lectures after the exam for this segment here, for this bond segment and the put call auction segment. Usually I complete it in 5, so it gives me the latitude of losing one somewhere, so that happened this time around. We have this lecture, then 2 more, and then the next exam, and that's more than enough time to complete the material that we need to cover before that exam. I have completed the detailed chapter on options, and I am in the process of proofreading it slowly. When I complete those chapters, I either speed proofread them or proofread them slowly, depending upon how much time I have. This one is so complicated that I'm going through it very carefully, and the reason that a problem arises is because I change all of the examples every year. And so I have to go through the text and change every single little bid, ask, price, difference, formula to reflect those changes, and it's easy when in a rush to skip over something and leave last year's value, and I'm sure you've encountered that in other chapters you've read by me. So the put call option chapter is sufficiently complicated where I can't confuse you by allowing that to happen. So I have about 2 hours remaining on that, and as soon as I get that done, I'll have it posted by a few days prior to delivering the lecture about put and call options. It would be helpful to understand those lectures if you have a chance to read that put call chapter this weekend, because that stuff I go through pretty quickly. It's quite complicated. Once you sit down and figure it out, you figure it out, but there's a lot of jargon, a lot of terminology, and conceptually it's kind of difficult to understand when you're seeing it for the first time. So let's press on and make sure I get through this material on bond values and interest rates to keep up with the pace. You might have heard in the news today, this happened this morning, or it happened our time at 11 o'clock, that the Federal Reserve System cut interest rates formally for the 3rd time this year, and then indicated they probably wouldn't do this now for a while. That was implicit in the recommendation rather than explicit. And so this will have the effect, if you understand what it means, of cutting the federal funds rate target from 1.75 to 1.5. As I've already pointed out, as far as I'm concerned, this is an unwarranted and unjustified rate cut. About the last thing we need in this economy at the current time is lower interest rates. The 3rd quarter GDP data came out this morning also at 5 o'clock our time, showing that the economy is still growing in the 3rd quarter, and this is the first estimate of multiple estimates will be made about that growth, and sometimes it is revised considerably. But the first estimate of many shows that the economy is growing at about 1.9%, which isn't far off from what was expected, but is not really strong, robust growth. The manufacturing sector of this economy is in a recession, essentially, at the present time, but the services sector still continues to expand at a fairly tepid pace. So this might be justified as expanding that, but you really need low interest rates to stimulate your economy out of a recession. And we won't have that tool available if next year or the year after we have a recession. Now, I ended in a rush last time because we didn't really run out of time, but I had to rush through 2 slides. And I want to make sure that I leave this point in your mind about this. What I've just said is part of that. In the past, we have always managed to recover from the depths of these bad recessions by specifically using monetary policy. And that monetary policy is very simple in its execution. The Federal Reserve System drops target levels of interest rates and sometimes drops them very much. And at the same time, and actually as part mechanically of the same kind of operation, they flood the economy with credit. And that pulled us wholesale out of the last recession. That was quantitative easing 2 and quantitative easing 3 and those earlier programs. It also pulled us out of the dot-com recession that we had in 2000. And it has pulled us out of every other recession that we've had during my lifetime at least. Now, the complaint here coming from me and other economists, including economists much more conservative than I am, is that we are removing this tool from the toolkit right now by pushing interest rates to such low levels. Because how can you drop interest rates if they're already at 1%, as opposed to, say, 6% or 7% or 5%? And so this introduces a policy warning that is reflected in this slide from the last slide set. Now, one of the results of quantitative easing 2 and 3 is that it flooded this economy with liquidity. And you say, well, what exactly does that word liquidity mean? It means just generally a huge availability of credit, ease of getting credit, no matter what your source, and that results in the proliferation of monetary assets of all kinds, including the kinds that we're talking about here in this class. There's been a substantial expansion of stock offerings through IPOs. There has been a virtual explosion of bond and note offerings offered by corporations. And your own government is running trillion-dollar budget deficits, which requires $1 trillion of net new U.S. Treasury security issues every year that we do that. And all of this is sort of out there and being sopped up by this easy monetary policy. And this is what most economists refer to as the flood of liquidity. And so I write here, this flood of liquidity justified by recovery from the last recession has made it very easy to fund business expansion and international projects with junk bonds and below investment grade bonds in general, meaning bonds rated BB or below. Companies like Frontier Communications and projects like shale oil drilling were funded with these kinds of bonds, as were companies like WeWork and others that are IPO bound. Now, Frontier Communications is the company that bought out Verizon's old internet service, basically, for the largest part. So if you remember Verizon, Fios, and all that, well, Frontier Communications bought that and now owns all the landline business that Verizon used to have. That company was created out of nothing and was completely funded by the sale of junk bonds. This is what enabled them to buy all of that lock, stock, and barrel from Verizon. Verizon wanted to sell it because they were involved in the potential for an antitrust lawsuit because of their own merger activity, so forth and so on. So the general availability of all kinds of credit at very low interest rates, despite high historical risk, has been the hallmark of the last 6 or 7 years. Because of the explosive rallies in near all markets in 2017, 2018, 2019 have been more or less sideways year with a slight creep up. The S&P 500 did set a record yesterday, but it's only slightly above records that were set in previous months. Because of these explosive rallies, the effective market yields of these bonds and the ETFs that make up these bonds dip far below any reasonable threshold defined by risk ratings described in this lecture, meaning the previous lecture, despite the fact that default rates are clearly rising. In 2018 and 19, I should have in 19, the rates are higher, but still not very high by historical standards. Default rates are low. But I showed you a graph that showed that they're highly cyclical, and during normal expansions, they're very low, and then they explode up to in excess of 10% at the first sign of a downturn. There will be a day of reckoning. I also said this last year, nothing has happened, and since this is slide is actually 2 years old, I've said this for 2 years and nothing is happening. But I've always said also that the one thing you can't predict in the economic world is turning points. The turning points just come all of a sudden for whatever reason they do. All right, so continuing that, I also brushed over this slide. I want to make sure that you understand it. Because, of course, the temptation in the modern era for those of you who are seeking to find safety in your investment portfolios, especially in your investment accounts, is to buy bond-based ETFs. They're everywhere. thousands of them, as we pointed out in that lecture, lots of ETFs. Some of them are investment grade only, some of them are treasury only, but a very large selection of them are mixes of investment grade and junks, and some of them, like J and K, are simply pure junks. And those are among the most heavily traded ETFs every single trading day. When you take a look at the volume of ETFs traded every single day, often SPY, the S&P 500 tracker, is at the top, but on some days it's not. On some days it's tilt. On some days it's junk. On some days it's LQD. And so these bond ETFs are very, very heavily traded and held in very large proportions in inventories. Now, the one warning that people don't know about out there that the actual industry itself is issuing to buyers or potential buyers is that bonds don't sell like stocks. Most bonds are fairly illiquid. You can look at a bond that's actually fairly conspicuous, like one of the Verizon AA or single A 10-year notes or 5-year notes or 7-year notes. And you can see there has not been a transaction for that security for 5 or 6 months in some cases. They sit there without trading. They sit there with the bid-ask going up and down, but nobody actually trades off the bid or the ask. And when you get to more obscure bonds that are rated BB or BBB or worse, BBB, double B, single B or worse, then the liquidity even goes down more. So that means if you decide, all of you, to unload or liquidate your bond ETFs, you may remember how those ETFs withdraw their shares from the market using their so-called participating units. Remember, that was very complicated. They do that only if they can do that, and they will do that only if there's a market in which they can sell these bonds at discounted values. Now, the prospect of that market perhaps not being there is actually reflected in the prospectuses of the security offerings that these companies make. I chose this one out of the HYG, which is the iBox high yield, that's junk bond ETF, that's also very popular. And they call this authorized participant concentration risk. You say, well, what the hell does that mean? You should know what it means because we told you what an authorized participant is. That's the big sort of market maker that buys these big chunks of shares sold by ETFs before they're offered to the public. That's the intermediary group that I showed you in that complicated slide. What we're saying is if they are concentrated in very few numbers and they are unable to sell their inventory, they're not going to be able to perform that all-important role of liquidating those ETFs as their popularity wanes. So the actual prospectus says that honestly and ends with the statement that fund shares may be more likely to trade at a premium or a discount to NAV and possibly face trading halts and or delisting. And that's what might happen. They're simply delisted, in which case there is no liquidity at all for a very long period of time. And finally, when they're able to unload inventory, it would be at a deeply discounted price. And you, who thought you were investing in a safe asset because it had the name bond associated with it, would be losing a considerable amount of money. And that's the danger that no one knows about out there in the face of all of this, because this is relatively new and we keep everything on the surface in the United States. There's no detailed analysis of anything out there anymore, it seems. So it's rare to hear anyone describe liquidity risk as a potential for bonds, even though it's a distinct potential that they list as a risk right in the prospectus that they issue when they sell the bond.
You were talking about how for certain popular bonds, the bid and ask queues can go for several months without a transaction actually happening.
Right.
Why don't people try to get in on that and spread arbitrage and make it go liquid?
Well, they are currently arbitraged. The question is, will that arbitrage continue if the market collapses? That's the issue, right? The arbitrage which keeps these markets moving and more or less keeps the market price in alignment with NAV is what makes it work. So the danger is the arbitrage stops, not that it would start. So you say, well, if you see liquid, how is it that it's keeping it in alignment? Computers keep it in alignment. And by that I mean the algo trading computers that trade these bonds or work for these big firms that trade bonds, Simply calculate the NAV and recalculate the NAV all day long. You could design one, you could this big on a little Linux box and do it yourself, and calculate the NAV. You'd have to pay the access fees to the bond market, and that's absolutely staggering. $20,000 or $30,000 a year to get rights to get the data to do it. But if you had the data, you could do it, and it would show that if the NAV went up or down like that, you would adjust your bids or asks to specifically, in fact, do the kind of arbitrage that would give you a profit if the market moved away from the NAV. Now, what actually happens is those computers just silently, all day long, move those bid asks up and down with nobody making a trade at any level all day long, right? And so it gives you the appearance of liquidity because the bid ask structure is keeping up with the NAV, which is determined on the market value of the bond, or vice versa, but it doesn't mean the liquidity is actually there. So for the bond, on the bond side, see. Okay, we need to get to the point where you understand this inverse relationship between the yields on these securities and their market values, because we've stated it, we've shown examples, we've talked about the danger of it, but we haven't established why it's true. And that's the purpose of this lecture. Okay. When we talk about the yields on these assets, I need to be very careful with the jargon that I'm using. So I'm going to be very precise about what it is I'm talking about in this lecture. First of all, we have to remember that yield-bearing financial assets have two categories of payouts that they make to reward you for owning the asset. Remember, they're debt assets. The first is the coupon payment that is made by bonds and notes by definition, and that is usually semi-annual, but sometimes annual, sometimes quarterly, but usually semi-annual. And for treasuries, we know it's semi-annual. That is determined by the coupon rate times par. Never determined by the coupon rate times the actual market value. It's always the coupon rate times par. The coupon rate and the coupon rate times par is the one constant in our equation. The other type of payout is for money market financial assets, including treasury bills and all classes of bills, which is the discount, where although no interest payment is actually made to anybody ever, you never get a check or an online transfer of funds by virtue of an interest payment. When you buy the financial asset, you always buy it at a discount, and it is redeemed at par, and the interest earned is therefore implicit in that small capital gain. So when dealing with yield-bearing financial assets, the payout is of these two categories. Notes and bonds are of the top category. They make coupon payments. Money market assets and bills, or bills are money market assets, are in the bottom category. They're sold at discount intentionally. I'm not talking, by the way, specifically about the discount associated with the Dutch auction. I'm talking about the fact that in this case, 13-week bills, 26-week bills, 52-week bills are always sold at discount during the Dutch auction, whereas in bonds or notes, that's not necessarily true. There are three yield calculations that you need to know. Two are very elementary, one is very complicated. And I'll tell you what sense you need to know it about halfway through this lecture. First of all, we have the coupon yield, which is not calculated because it's stated. The coupon yield is announced in the offering, the prospectus of the bond or note when it's first released. It is permanent, it never alters, and it assures that the coupon interest payment that is mailed by the borrowing entity, the U.S. Treasury, is constantly always exactly the same value through the life of the asset. So if it's a 5% 10-year note, then you're going to get $5 per 100 in two separate checks, $2.50 each, 6 months apart for 10 years, if that's what we're talking about. So the coupon yield is not calculated. It's the only thing in this that's a constant. The discount yield is the yield we're referring to the actual yield on a money market asset and or a bill. A bill is a money market asset, another name for money market asset. All right, so the discount yield is the calculation of that spread adjusted for time between the discount that you pay to buy the bill and its par value when it matures. And so that's the first formula we'll look at. The second is called current yield, and that's on notes and bills, and it has a formula that we'll look at. And the third is called yield to maturity, or ask yield, which is the true actual yield of that financial asset to you when you buy it, given whatever price you paid for it. Okay? So the word rate and yield are sometimes mixed on these discussions. Usually the rate refers to the coupon rate, also called the coupon yield, because again, that is fixed. But the term that describes the rate of return that you specifically get on your investment, given what you paid for that investment, is referred to as yield. And there's two categories of that, current yield and yield to maturity, also called ask yield. And those two distinctions we're going to make today. Now, the coupon yield itself and its relation to the coupon payment is the constant we're talking about. So if a bond or a note has a coupon rate that is stipulated in the contract, and remember that's actually written in the contract because we saw the prospectus for a 10-year note in one of the appendices in the previous chapter, and we saw that it was 3.75 or whatever it was. And so the coupon payment for U.S. Treasuries is always going to be equal to par value times the coupon rate divided by 2. That's the constant always in these equations. So if we have a February 2043 bond with a coupon rate of 3.750, then that bond is going to pay $1.87.5 semi-annually per $100 of par value. So everything is always priced in terms of par. Again, your ownership is in multiples of par, like $1,000 worth or $10,000 worth or $1 million worth or so. So when we take a look down there again at the 11/15/2043 long-term bond that has a coupon of 3.750, we are specifically saying that the interest paid on that per $100 is $1.87.5, and that never changes. That is a constant. That is the one constant in these formulas. To understand that is critical to understand anything else that follows. So that is contractual. The government says, we'll pay you that amount. Now, it doesn't matter whether you bought that at a slight discount or a premium. That calculation is made based upon par. So whether you bought it at a premium or discount, you're going to get $1.87.5 per 100 for the duration of the time that you own that bond if you're the owner of record on the coupon payment date. Okay, so discount yield, which is the first of the three formulas, is again the formula that shows how the United States Treasury and the financial markets calculate the yield of a money market asset. And again, they don't actually pay interest. They're sold at a discount. In this example, we're assuming that we're talking about a 26-week bill that was sold at 96.16 in the Dutch auction. So this is a bill that's going to expire in 26 weeks. When it expires, it'll have a redemption value through Treasury Direct of exactly 100. We paid 96.16 for it. And so adjusting for time, and they use these formulas like 365 over 182 because these are based upon the methods used at time when computers weren't available, and they never changed the method, so they still use this formula. 26-week bill selling at 96.16 yields 8%. And that's what they'll say. It's an 8% bill. 100 minus 96.16 over 96.16 times 365 divided by 182 gives you 8% or so. So that formula tells you what your effective yield is on a money market asset. And of course, it's solvable in reverse. The discount price when the yield is known is just flipping the thing around for this formula. It's by example down there, you can see how the 96.16 was arrived at. You take that and solve it. I'm not going to require you to know this formula. I want you to understand the concept. This formula, by the way, is so simple that it's strictly logical. So there's no reason why I shouldn't require you to remember it. It's discounted, adjusted for time. The discount formula is a standard formula, but I decided I'm not going to ask you to remember this. There will be one formula that I do ask you to remember, the core long-term formula, and then I'll explain what it is I expect you to know about it and remember about it, and what I don't expect you to know and remember about it. On this, I want you to understand the concept on how these securities are sold and effectively where the interest rate comes from. Where'd you get that 8% from? Did they pay you a check that's equal to 8% of the value? You say, no, they did not. I bought the bill for $96.16. I held it for 6 months and I redeemed it for $100, and that equals an 8% rate of return. That's the concept I expect you to understand. Therefore, over the life of this bill, it'll follow this pattern here. It'll be issued for 92, whatever I said, 92.16. This is a 52-week bill, sorry. This is a 52-week bill at 8%, so that one will be issued at 92.5, and it will simply rise in value to 100 a year later. It is the case that in the market, these bills will deviate from this straight line by a tiny amount, and that's because short-term interest rates over this 52-week period are rising and falling. And so this will always reflect what the current market rate is and not what the coupon was on the day that it was issued. But even if it bows up a little bit or it bows down a little bit or it wiggles around it like a very compact sine wave, it's going to end up at 100 in exactly 1 year because it's a 52-week bill. Because of that, of course, the deviation is not going to affect it very much. Today's decision by the Federal Reserve System would actually cause this, if it was issued a few weeks ago, to rise a little above the line. So, because effectively interest rates are falling, and that means, therefore, that the value of this asset will rise in value in the interim before it matures. So if we were halfway through here and it's 95.5, the decision today by the Fed might move that 95.5 to effectively 95.7. to put it consistent with the new lower rates on 6-month securities. But again, even though it may bow above in the face of rising rates or go below in the face of falling rates or oscillate around in volatile rates, it's going to end up at 100 in 1 year, and it's going to have started at 92.5 when that year began. And that's why these are safe assets. If you're unhappy with the current rate of return, you just wait for it to mature and you sell it for 100. It'll always give you the rate of interest that you thought you were going to earn when you bought it in the first place if you're patient enough to wait until it matures. That, of course, is not an option for a 30-year bond. You can't really wait necessarily for 30 years to sell your bond because the reason for buying it in the first place probably did not have a 30-year time horizon that ended it. If you bought it for your retirement and you're 70, well, you won't be 100 to cash it in. You will have been dead for 25 years. So that's why it doesn't work for the 30 years. The second is current yield. Now, current yield is a concept I would just as soon forget. It's in the papers all the time and it matters, but it doesn't mean very much. It's basically the calculation of a short-term yield that acknowledges that you get a coupon, but you may have bought recently this asset at a premium or a discount, so your effective short-term yield is this rather than that coupon. And so you say, okay, current yield is the coupon rate times par over the ask price. So if the ask price is not 100, then the current yield will not equal the coupon rate, obviously. If it's above 100, mathematically, then the current yield is going to be below the coupon rate. And if you bought this asset for less than 100, such as 98, then it's going to be above the coupon rate. In this example, we're looking at the same bond, the 11-15-2043. They don't list the current yield in the Wall Street Journal, but we can calculate it. We can say, yeah, this thing pays an annual rate of 3.750, but its current price is not 100. It's selling at a premium. Its current price is 118.27. So the current yield on this is not 3.75. It's actually 3.171. So it's lower because you're paying a premium for it, even though the coupon is fixed. Now, if we found another example where the bond currently is trading at a discount, like 96, then the current yield would be above the coupon rate. So you say, well, that actually makes sense. That's a more accurate indicator of how much money you're making on your investment than the coupon. So why don't you like it? And why doesn't anyone like it? It's because it does not take into account the implicit capital gain or capital loss given that you bought this bond at a price other than 100. And an accurate indicator of your rate of return has to do that. And so the ultra long-term formula, the complicated one, does take the implied capital gain or capital loss into account, whereas this one does not. Okay? So we need to get to that all-important formula. But we also, more importantly, need to get to the concept that I've been explaining to you a few times over that has been confusing a number of you. So we say, okay, you bought a bond with the following features. Let's make up an example. I say, well, you know what? If you buy a 5% bond, it's a 30-year bond, then interest rates rise, then this bond's going to fall in value. If interest rates fall, this bond's going to rise in value. And a lot of you say, why? Explain why, okay? Well, that's what this effort is going to do. Here we're explaining how the market is doing it, then we look at it mathematically. So it's important that you understand this, all right? So I make up this exaggerated example, and I think this will help explain why these move inverse to each other, as we started saying about 3 lectures ago. Suppose 10 years ago you bought a new bond with the following features. It was a $1,000 bond that you bought at par. You bought it at a value of par. And most of the bonds are sold right around par, like 99.85 and the like, but sell them at par. We'll just say you bought it at par. It is a 30-year bond. You bought that bond, though, 10 years ago, so it is currently competitive and has the same cash flow features as a 20-year bond. The coupon rate when you bought it was 5%, and as we know, that never changes. Also, that means that $50 yearly is paid to the owner of that bond. That also never changes because, again, that's the one constant. Okay? Now today, 10 years later, we're saying that brand new issued 20-year bonds are selling for 10%, or yielding, I should say, 10%. Their coupons are 10%. Let's say it's an inflationary period. And you want to sell your 10-year-old 30-year bond. You have to be obviously competitive with the new 20-year bonds that are being issued because they have exactly the same features. If it's a semi-annual bond, the 20-year bond that you have still has 40 coupons left. A brand new 20-year bond has 40 coupons left, and so they have exactly the same features. They'll pay coupons at about the same time, they'll pay them twice a year, and they'll pay them for 20 years. So as far as the investor is concerned, there's no real difference between a 10-year-old 30-year bond and a brand new 20-year bond. So the question is, given that your bond has a coupon of 5%, can you sell your bond today to the open market at par? No, you can't sell the bond at par because it's only yielding 5%. And it's competing with bonds that are yielding 10%. So nobody's going to buy it. Why would they buy a bond that has 40 coupon payments that yields annually only 5% when they can buy a bond that has 40 coupon payments that is yielding annually 10%? So no market for it at par. Can you sell it at any price? Of course. You can sell it at a price that would make it more or less consistent in its effective yield with the 20-year bond. And what would you have to do that? You would have to sell it for the price of $500. If you sold it for $500 and it has a 5% coupon, then its yield is 10%, just the same as the 20-year bond. See? And that's the reason why bond values in the secondary market and market interest rates move inversely. Because when you resell a used bond, you're competing with other used bonds that were issued at the different times but have the same maturity of yours, and you're also competing with bonds that are newly issued that have the same maturity of yours, even if approximate, if not exact. And so therefore, if the market is saying, hey, 20-year assets are yielding 10%, then your 20-year asset has to effectively yield 10% for you to be able to sell it. And if originally it had a coupon of 5, the only way that can happen is if you sell it for half its value. Now, obviously, I could reverse this, and we have interest rates rising, and we can say, well, in that case, I could sell it for a lot more. If interest rates had, I had paid 10% originally, and now interest rates are 5%, I could sell my bond for $2,000. So, again, no matter what example I give you, the bond's market value, given that its coupon is fixed, has to adjust to current rates. And that's why this inverse relationship exists. All right?
Does like time and risk play a role in that?
Yeah, you'll see that in the formula. The question was, what role effectively does time play? Ultimately, this is mathematical, so it has to be represented in a formula, right? So we're almost there. Okay? Suppose you have another example, the price-yield trade-off. Suppose you have a newly issued 30-year bond, which has a coupon of 8%. 10 years pass, again. Your 30-year bond is now the equivalent of a 20-year bond. It has the same cash flow characteristics. So this is the same example as last time so far. Therefore, if you wish to sell it on the secondary market, it must offer an ask yield, also called the yield to maturity, which is the effective true yield of this asset now, that is competitive with a newly issued 20-year bond. Now, in the last example, we said, and suppose that's 10% versus 5. Now let's consider the full spectrum of possible yields. What if the 20-year bond coupon is 6 or 11? What will this originally 30-year bond be worth? And so this slide shows the range of those possibilities. It is now 20 years later. And you saw this slide once before, but now I've put it in context. It is 20 years later. Your bond has a coupon of 8%. It's 10 years later, and you have 20 years remaining on the bond. Your bond has a coupon of 8%. So you say, well, what is its market value going to be? And this is where we're getting to the math you're asking about, right? Well, that depends upon the yield of the new competing assets. If they are 4%, this bond will have a value about $155. If, on the other hand, they are 12%, given that your bond's only 8, then this bond will, to be sold, have a value of about 67 or 68. So therefore, there's effectively, at any given day, a spectrum of rates that are possible in the future for where your bond might go relative to the coupon rate, and where it might go is determined entirely by market rates for competitive assets in the future. And therefore, generally speaking, this is why, clearly, bond values move inverse to current interest rates. All right, you can see this by this example. Now you say, yeah, that example makes sense. Can we make it more specific, more analytic? Yeah, we can do that right here. Ask abstractly what a bond or a note is worth mathematically or in a modeling sense, instead of just what common sense tells you it would be worth in a market. A bond or note, given what it is nothing more than a future stream of cash that has a value. Now, that's not true of a stock. A stock, I guess, can be thought of as a future stream of cash, but you haven't the slightest idea what that future stream of cash is going to be. That depends upon the dividends that they are going to pay that they haven't yet announced. It depends, obviously, on the capital gains or capital losses, and nobody knows where that's going to be. But if you're talking about a United States Treasury security, specifically a bond or a note, you know exactly to the penny what the nominal cash flow is going to be for that asset, because you know when every single payment is going to be made. They're made on the anniversary of the sale of the bond and exactly 6 months in between those two, throughout the life of the bond until it matures, and then the final value of the bond is redeemed at par. So you know beyond any shadow of a doubt what the nominal cash value is of a treasury bond or a treasury note. It is therefore worth the present discounted value of all those future cash payments. And that is the crux of all fixed asset valuation, that reality. All of the valuation formulas are present discounted value formulas of anticipated future cash flows, no matter what the asset is you're talking about. Sometimes it's stochastic, as they call it. Now, what do I mean by that? That's when the future payment is a random variable instead of a constant that's known. For a treasury, it is never a random variable, at least if you're talking about the nominal yield, it's not. For a corporate bond, it not so much if it's investment grade, but maybe it is if it is junk bond. Because at some point, a value that is presently 22 may have a value of 0 because they default before that payment is made. And then for those exotic assets that I briefly talked about, called collateralized debt obligations, where the investors only get the payments made by people for the interest on their credit cards, that's fully stochastic because nobody knows what that value is going to be, because your decision to pay or not pay your credit card, or pay it off in full, or make the minimum payment is entirely arbitrary. But for treasuries, there's no doubt about it. The cash flow that you get is constant, it's fixed, it's calculatable. So all we need to do is calculate the future cash payments. To understand the pricing in bonds and notes, you understand the math of compounding and present value calculations. So for a bond, it's as simple as this. Now we start in this example by the simple bond formula, which I have here on this slide. This is the formula I expect you to know from memory, because this doesn't require you to memorize. This is strictly logical. This is a logical expression, right? And this is the simple one. I don't require you to know the complex one. I require you to know the simple one, because you don't need to memorize anything. You just use your head to understand the logic of it. But before we get to that, let's get to an example. So to value a bond or a note on the secondary market, you need to know the coupon rate, the time remaining in the life of the bond, and the present day yield of equivalent bonds, the competitive yield, the yield that we've been using to revalue our bonds, right? So we ask, in an elementary sense, what would be today's value of a 30-year bond issued 10 years ago at a rate of 12% if other bonds with 20 years remaining until maturity today yield only 6%. So 30-year bonds sold at 12% during an inflationary period. I use the higher levels because you can see it in the math a lot better, right? 10 years ago, we sold a 30-year bond for 12%. Inflation has come down, so now 20-year bonds are yielding 6%. What's our 30-year bond worth? So, and how do we value that, right? So you say, well, logically, if this is a bond that pays one annual payment, then the calculation is simple. So this is not the formula for a treasury bond. This is for a simple bond that is only paying one payment per year at the coupon rate. So for the $100 par, this is paying $1.20 one time per year. That makes it easy. You say, okay, what do we have to do to calculate this? We have to calculate the present value of each component of the cash flow individually and then sum that, and that's the value of the asset. And that is the method, by the way, to evaluate all yield-bearing financial assets in existence. It's a summation of present discounted values of all the component payments, no matter what it is. So you say, that must be pretty easy to write up in Python. And say, yep, it sure is. All you have to do is write the one formula and just run it through loops 12 times or 24 times or 32 times or 90 times or whatever. So we say, okay, so that is, we have 20 coupon payments, and so the present discounted value of each of those is the coupon rate times 100, so that's the annual payment, divided by the 1 plus the current competitive interest rate to the power for the first year of 0, to the second year of 1, to the third year of so forth until we run this out up until 20. Or I'm sorry, for the first year 1, because the payment's not for 1 year, it's not today. And the second value there, 100 divided by 1 plus y to the power of 20. What's that the value of?
Is that the future value?
It's the value of the redemption value, right? The present value of the redemption value of the bond. What is that $100 delivered in 20 years worth today at a competitive yield of Y, which in our example here is 6%, okay? So therefore, the summation of this elementary 20 years remaining on the 30-year bond requires that we calculate the present discounted value of each coupon and add to that the present discounted value of the full redemption. The latter is 100 divided by 1.06 to the power of 20. So when we solve it, we say, okay, we got I is equal 1 through 20, 12 over 1.6 to the power of I plus 100 divided by 1.06 to the power of 20. Now, when we solve this, we know we're going to get a value of higher or lower than 100, given what we've set up here, right? It's going to be way below 100, isn't it? Because this has fallen in value. Now, here's the formula for the shorthand notation that you're more familiar with. It's just a summation formula. And this is the formula that I think it's reasonable for me to expect you to understand. C is the coupon amount in the numerator. It's par times 100, the coupon amount, right? R is the present yield of this bond market determined. Now, this is a simple bond in the sense that we're talking about a bond being priced on a coupon payment day or at its origin at a single interest rate payment per year, and that makes it very easy. So all traditional bonds use this core pricing formula. Not all of you are from Harvey Mudd, not all of you are familiar with this math notation. Another way of writing it is the longhand version of writing it, okay, if you're not from Harvey Mudd. And so it's a coupon rate, 1 plus R, then that's the present discounted value of the first year's coupon. Then the next is 1 plus R squared. That's the present discounted value of the second year's coupon. Then you add 1 plus R cubed, the present discounted value of the third year, all the way out to the maturity, and then par over 1 plus R to the power of remaining time. So each of the C calculations is the present discounted value of each of the coupon interest payments. And then finally, the present discounted value of the redemption at par. And the entire asset is worth the present discounted value of its future cash flow entirely, which consists of interest payments, in this case 20, and a single redemption value. So to ask you to understand that that is at the core of all bond valuation, I think is reasonable, because it's logical.
Are we assuming that our coupon payments are getting reinvested?
No, this is just the cash flow. This does not treat what happens to the cash once it's paid to you. Okay, so no, the coupon payment is yours spent, but no longer in the formula. That's right.
So is money today worth more than money tomorrow?
No, the other way around. Yeah. So, because of course, look at it in reverse. You can take that money and invest it in a bank with a positive yield. So money today is worth less than future money. I mean, money in the future is worth less than money today. The discount formula works in reverse. If you say, you win the California lottery, right? So you say, how do you value the California lottery? Because they pay it out over 20 years. Which is more valuable, the first payment or the last payment? Because they're constant. The first payment is way more valuable than the last payment. So you say, well, what if I take the last payment now? Then they have to discount it to the present, and it's going to be a much lower value, right? So this bond formula works the same way. It's just discounting because you can always take the money. Suppose you say, well, let me take the last payment now, and you say that's $100. Let me take it now. Then you can take that last payment, which they don't have to give you for 20 years, and put it in the bank for 20 years, earning 5%. It's going to be worth a lot more than $100. So that's why. Okay. This is the reduced form of the elementary bond formula. That's, of course, there in case you want to program it for something, because this is where you don't have to actually write it out as the summation. These are the original formula is a geometric series, and this is the reduced form equation. All of these reduced form equations are in the appendix of Chapter 8. where we use the geometric series to reduce them to the reduced form. You're not required to know that, but in case you wonder where the hell this equation come from, that's where it came from. And so this is the general formula of this expression right there, which is another way of writing this expression right there. And when you plug it in Python or Excel or whatever, then we say we have the current market value of a 30-year bond that was issued 10 years ago and has 20 years of life left and pays a coupon of 8% per year, given that interest rates now on a 20-year bond are only 5. This bond will sell for $137.39. Okay? If it's at a discount, this shows the current market value, which in this case is $82.97 of a 30-year bond that was issued 10 years ago. It has 20 years of life left, but pays a coupon of 8%, given that interest rates now an equivalent bond are 10%. So this bond would yield this bond has a market value of $82.87. So it's just plug and play in this elementary example. Then you say, yeah, but Professor Evans, the rates are paid semi-annually. Does that complicate it? Yeah, unfortunately it does. And so if you have periodic interest rates, then you have to change the formula to reflect that. Because you have not 20 remaining coupon payments to discount, if you have semi-annual payments, you have 40 to discount. So you effectively discount all 40. Now keep in mind, you say, you don't actually discount 40 of them because all of these have reduced form formulas like the one you're looking at here. But the best way I think to remember it is in the long formula because that's the logical formula, right? This is just derived from the geometric series. You could never figure that out except by deriving it from a geometric series. But the long one is common sense. So when it's paid semi-annually, this is the mechanism used because this is the traditional mechanism. You might say, wouldn't it be better if we were using continuous compounded rates like logs, like you do in everything else? Absolutely. This would be more accurate in terms of accurate yields if we were using logs. But traditionally, they haven't used logs, so they do this. So this is the coupon payment. But now it's times 1 plus r divided by 2 to the power of I. But there is no longer 20 of those. There's now 40 of them if we have 20 years left. So I has a value that runs from 1 to 20. Now this is the periodic, so this applies no matter what your periodicity is. If it's semi-annual, then M is equal to years times 2. If it's quarterly, then M is equal to years times 4. So this is the general periodic payment. And so you say, okay, that makes sense. It's going to change the answer a little bit. All right. So that's how you adjust for the fact that you have more than one interest payment per year. Then you say, yeah, but Professor Evans, suppose I buy this. It's a used asset, right? In between coupon payments, right? Oh, that complicates it a lot when you buy it in between coupon payments, but unfortunately that's the formula we have to learn in our Python or whatever to calculate it, but it's not one that I require you to know, except at one level, as you'll see, I require it. Okay, so this is the actual bond pricing formula. And what happens is because you buy the bond not on a coupon payment date, but somewhere in between, then all the exponents turn into floats. You know, before they were 1 or, well, in the half yield, it was also a float. Oh, no, it was not. It was, in the half yield, it's still an integer, I mean. But here they turn into floats. Because, first of all, if you're buying it, let's say 2 months after the last coupon and 4 months before, then we have to take that into account. And this is further complicated by the fact, and don't miss out on understanding this, or you'll never understand this formula. If you buy a bond 2 months after the last coupon payment was made, you buy the bond for the price that is stated, but you also have to pay accrued interest to the former bondholder from whom you bought the bond. Because of course you do, right? They have earned that interest for the last 2 months. You have to pay them, and that really complicates the formula. So when you look at it, it's still the same formula. You take every coupon payment that remains, but now the coupon again is equal to C, and that is par times 100 divided by 2 in the case of a treasury. On this one right here, the C is the coupon amount, and that's the coupon rate times par divided by 2. This is still the coupon amount, the 100 divided by 100 times the coupon rate divided by 2, and it's still discounted by the interest rate adjusted for seasonality. So M is normally 2 for a treasury, or is 2 for a treasury, as before. Par is done the same way. It's 1 plus R to some power. And then we have another term at the end that we have added, and that's the amount for accrued interest owed to the other player. Now, the exponents, you can figure out whether you think they make sense or not. A represents the number of days between the last coupon payment and the settlement day. P is the number of days in this coupon period. N is the number of remaining coupon payments, and so forth. So you have to know all of that. Now, again, once you put it into a formula in Excel, Python, JavaScript, or whatever, then once you have it, you've got it, right? So it just takes into account that basically the exponents are turning into floats because you have segments of the period to pay. Now, and we'll show by example, when you see the example, it'll be obvious to you. The first discount won't be 1, it'll be like 0.8 because part of the period is already passed. And the next one will be 1.8, the next one will be 2.8, and the right. Okay, this term here, again, to remind you of what it is, when you buy a bond, you owe accrued interest to the seller. It will be interest accrued since the last coupon payment. It will be equal to the value of a single coupon times the portion of the coupon period since the last payment was made. All right? So it's the coupon amount divided by the segment that is already passed. So if a third of the segment is already passed, it'll be a third of the coupon payment. That makes obvious sense, right? Now, the best way to understand this is simply to look at an example. So here's a 30-year bond issued on September 15, 1999. The purchase date is February the 8th, 2009. I don't change this because it's this one I'm not going to go through every year, so I use the same example over and over again. The next coupon date is March the 15th, the first of 42 payments remaining. The redemption date is September 15, 2029. The coupon date rate is 8%, yielding $4 per coupon payment. The present market ask yield is 10%. So A over P is equal to 0.8022. So this starts at 1. And so this is 1 over 1.05 to the power in the first case of 1 minus 0.8022. And then the next time around, 1.8022, then 2.8022 or whatever. And the final redemption value is 1 over 110 divided by 20.60 minus the accrued interest is 3.21. So the value listed in the Wall Street Journal is 83.31. All right. So again, all we did was take into account that you're buying it on some day other than a coupon payment date, and that it pays interest more frequently than once a year. And we kept it logically consistent. Now that has a reduced form of the complex formula, and this is what you program when you do these things. And there's no way to explain that other than say that's a reduced form from the original thing we started with. And so you solve that by putting in these values, and you get 4 times this over that, and this times this, equals 83.31. You say, oh my God, that's a lot. It's actually not. We've only taken the core formula and modified it twice. Therefore, here's what I expect you to know from all of this. It's important to me that you completely grasp the concept about why this goes up when that goes down. And to the extent we say for longer term assets, it will go up more. To look at the math explains why it goes up more for longer term assets. So here's what you need to remember. Now, this, unfortunately, is not in the PDF files. It's only in this slide set here, and that's because I forgot to stick it in until I was sitting here, and then I remembered at the last second. And so this is not in the PDF file. This is only in this, all right? So make a note that this is what you need to remember. So what you need to remember is a little bit about the difference between the simple bond formula and the complicated Formula 23. This is Formula 23, all right? The simple bond formula is that, or that, whichever way. This is reasonable to say you should know it because it's logical. You don't have to memorize it, it's logical. Of course that's what it is. It's the present discounted value of all the payments. How do you represent the payments mathematically? So here's what I'm asking you to understand for the exam. They differ because, one, we want to calculate values on days other than the days in which interest payments are made, which turns our exponents into floats. How it does that, I'm not expecting you to know. It's just, you can figure it out anyway, you know. And which requires a calculation of accrued interest because, of course, to be fair, it has to, right? So that's why we have to make a modification to this formula. Two, they differ because we need to calculate values if more than one interest payment is made per year, which increases the number of discounted coupon payments by the factor X, which is 2 in the case of treasuries, and requires an adjustment to the effective rate in the same proportion. So R divided by 2, R divided by 4, R being the annualized rate. So obviously you have to do that. And then finally, we need to calculate accrued interest because we owe it, and that's that little term at the very end that wasn't in the original formula. This, I think, that you need to make some kind of adjustment is reasonable to ask you to remember. How to do it is not, because that would just be requiring you to memorize something that's almost beyond memorizing. I have asked people in the past, though, what is Formula 23, and about 2/3 of the class memorized it and had it all there with all the exponents, 1 minus A over P, all that. So I think, well, you know, it's important that you understand the concept. It's not important that you memorize that. But aside from stochastic valuations of some things, you now know the method to calculate the present value of any yield period asset traded in any market anywhere in the world, because they all use this formula. The stochastic part of the stuff, where you don't know what the future payment is in even nominal terms, complicates this insanely, right? But that's not true for treasuries. Treasuries, you know what it's going to be. So, therefore, we say, okay, now that we have a tool that we can use, what can we say about using bonds as investment vehicles? Because that's what this class is about. What can we say about efforts to calculate effective risk for one of these assets now that we know all of this, right? You say, well, you can go a long ways. We remember that when we look at interest rates, let's look at the 10-year note history for 1962 to 2018. That's really wild, right? My God. There's just a certain feature to it that's astonishing. It rose effectively nonstop, but with obvious volatility day by day between 1962 and the peak of the inflation years in 1980. And then it fell, and it's been falling ever since. Quite remarkable. It has averaged 6.19%. We're talking about an asset right now that has a yield of 1.34 or 35 or whatever it is today. Yesterday it was 1.835, or 2 days ago it was 1.835. It's averaging 6.19%. If you take out the inflation years from 1978 to 1986, its average is 5.37%. And so that's a better indicator of its true nominal long-term average than is that includes the inflation years, you know. So this thing's normally around 5% and currently is 1.835 and falling. And today the Federal Reserve System decided to reduce it even more by reducing rates across the board even more. So here's an interesting question that we can ask and now actually answer with precision. What happens to a 10-year note issued at 2% And right now they're below 2%. If 2 years later yields have risen to 5%. That's an answerable question now. We can actually answer that to the penny because we've developed a means for doing that. Before we do, let's look at similar questions. Here's the 30-year bond history. Because 30-year bonds don't go back as far, this is a shorter history. This one starts in 1977. Their average was 6.68%. If we exclude the inflation years, it's 5.62%. Currently, they're yielding 2.33%. And we've seen what's happened to their values. They can range all the way from 95 to 140 because they have those quotes in the Wall Street Journal that we looked at. So here's an interesting question. What happens to a 30-year bond issued at 2.33% if 2 years later yields have risen to 5% for whatever reason? Again, this is now not only a generically answerable question, this question can be answered literally to the penny if you want to specify the exact rate that you're talking about in the future, because we have the means to do it. So let's do it. This was from yesterday's Wall Street Journal. This was the list of current yields and asks for long-term Treasury securities. This is only the segment of the page that has everything from maturities of 43 on. The page is 10 times longer than this because the page has all of these securities on it. We're only looking at 30-year bonds here, though, because those are the easiest examples, most dramatic examples. So we have one that let's choose this one. 11/15/2048 has a coupon of 3.375. It currently is astonishingly trading at a premium of 122. So you say, well, when was this bond issued? You know it was issued, right? You know exactly when it was issued. You know when it was issued to the day. If I ask you that on an exam, you would easily know the answer to that. It was issued on November 15th, 2018, because it's a 30-year bond. So what was interest rates then? 3.375, because that's the coupon. May a little high, a little below, because it might have been, as we know, through the Dutch auction, issued at something other than par, but not way far away from 3.375. And you say this thing was issued in November 2018. That was not even a year ago. And it's trading for 122. This has had a 22% capital gain in 1 year, and it's a blue ribbon investment grade United States Treasury bond. Wow, that's better than Tesla. That's better than Procter & Gamble. That's better than Apple. That's better than anything out there in the stock market, even in the dream years. And this is the 30-year bond. But of course we know it's true because we know it was issued in 2018, and it was issued at a coupon of 3.375, and we know it was issued for par. Wow. And so you say, well, okay, why is this bond, which isn't even 1 year old, trading at 22? Well, that's because interest rates have fallen since it was issued in the infinite wisdom of the Federal Reserve System. So there has actually been, all year long, a stupendous bond rally globally where those who have invested in these assets are raking in the cash. It's keeping the economy, which is barely struggling along at 1.9%, going to some extent. And the capital gains liquidity this asset is providing, and assets like this. How many of these are out there? Well, remember there's about $20 trillion of them, of the long-term bonds, though not that much, only $4 trillion of those, but they're all doing this, or all did this in the last year or so. Well, let's ask ourselves what happens to all of this if it reverses. And it's no longer an abstract question. What will this bond be worth in 2023 if 25-year rates are 5%? Now, again, we have to use 25-year rates because logically we have to compare cash flow equivalent assets, obviously, all right? So that's easy. Let's just take this formula right here, that one, which is complicated looking but really easy to program, and stick it in this Python program right here and solve for it, all right? And we did, and the answer is $77.37. That's the answer. That's what it'll be worth in today's date in 2023 if equivalent rates are 5%. That's the answer to the question. See, that's how you can use this stuff, right? Once you have the formula, you can program it. Then you can answer any question about potential bond values, hypothetical, based upon interest rates, and you can see exactly what these bonds are going to do if rates go to where they might go. If this actually happens, this bond will have gone through a life of starting at 100, going to 122, and then collapsing down to 7, maybe higher, but by 2023, collapsing down to 77.377, right? Now, again, what I expect you to know is the conceptual stuff here. I expect you to understand the implications of this. This is pretty obvious. And again, the one thing I said was in the transition from the elementary formula, which I am saying you must know, the elementary little bond formula, right? The 21-piece bond formula, if it's 20 years remaining, to the big one. Why did we need to make the steps we made? Not important as to how we made the steps, but oh yeah, we have to adjust for the fact that we're not buying the bond on its coupon payment date, which turns all those exponents into floats, and that we also are making more than one payment per year, which makes that small, and we owe accrued interest. All right, I think it's reasonable to say, yeah, you have to adjust for that. And so when you write your little program and whatever, you make sure that all of that is reflected in the program. Now you take this program, by the way, and resolve it backwards for today, and you get that right there. You get, not that right there, you get that right there. You get 122.08. Actually, it's off by about 10 cents. And that's because of the fact that this was used to solve the interest rate rather than the other way around. And so, you lose precision when you go that direction. So what we get, by the way, I mean by that is we get the market value, 122, because that's the observable value out there, right? You say, what's this bond worth? Well, what did it last trade at? Well, the bid is 122.10 and the ask is 122.06. And the last was 122.08, and so that's in between the two, so that's a current value. Therefore, using that formula in reverse, we solve it to get the yield of 2.315, because the rate, of course, is a derivative of the market-determined price in the real world. But the formula works back and forth. Say, well, can you rewrite the formula to solve for I? And the answer is no, good Lord. You got this multiple root problem. Instead, you use brute force to converge around it until you get to the solution, just the way option values are solved, just the way you integrate something in integration. Just use brute force to get to the obvious answer. You know what the answer is, so brute force your way to how you started to get there, right? So,
what is I?
What is I?
Yeah.
It's a counter. I is equal to 1 through 20, right? Yeah. It's a counter. Start with I is equal to 1 or I is equal to 0, and we count to, in the case of our formula, it's I is equal to 1, because the first coupon's a year away. If the first coupon was made for some reason on the day you bought the bond, which of course it's not, then I would start at 0, right? So this formula tells us that this one right here, this tells us that the first value we have to take into account is a coupon payment that is made a year from today. And so its present value is 1 plus that interest rate divided into the coupon amount. And so that'll be a value like 98.42 or something like that, right? And then the present discounted value of the second is 1 plus r squared. And so that's the standard discounting and compounding interest rate formula. I used to have those two in here, the discount formula, but everybody seemed to understand what it was, so I took it out. Maybe that was a mistake. Okay, so I wanted to make sure that I got through that and that you have a chance to figure out that you understand it and what it is I expect you to know about it and what the implications are in a world where interest rates have been pushed to historically low levels. This means that we are setting up ourselves in these massive markets for astonishing capital gains. Now, the economy can handle it, of course, if it rolls in slowly. It'll just be kind of like bleeding losses, asking for a long time on trillions of dollars of assets. that we can probably absorb. If it is accelerated, then it's going to be catastrophic. It's probably not going to be accelerated, though. It'll probably roll in slowly rather than roll in rapidly. After all, we have been through the seesaw already once, because remember, rates were rising. And when they were rising, these things were going down. Now rates are falling, and now they're going back up. So we went through a short period where they rose. They didn't rise very much, but the 10-year note rate a year ago was 3.3% or something like that. Now it's half that. So, the 30-year bond rate, though, has been more stable than that. It's risen and fallen about a percentage point over that period. So if it happens slowly, it'll just amount to substantial portfolio depleting long-term capital losses that are easily to absorb. But given the scope of capital losses that are possible on these ETFs that have trillions of dollars of these assets, you understand that if it becomes accelerated, then there's going to be an effort to sell out of them quickly, and we'll face the liquidity problem. So there is a really non-zero probability risk in these markets associated with this, okay? So when I come back and scare you on some other subject, it'll be on put and call options, which you'll find interesting. We're losing a lot of money on my trades right now. Sometimes that happens. We're down about $10,000 right now. However, we still got Uber and Lyft ahead of us, so Uber and Lyft may save us. But we're down about 10 grand. I'll tell you about them later when you understand what they are, okay? And we made it to 4 o'clock. Good. Try not to get blown away. And if they cut the power, just take advantage of the freedom it gives you. And happy Halloween. More than anything else, happy Halloween. We've got to stop this. Keep forgetting to stop this thing. Okay, are you sure you want to?